Can you see the presentation?
Not yet. Could you try it again?
Yes. Okay. It doesn't work?
I can see it, but can the others see it?
No.
Okay.
Maybe if somebody else wants to start and I can
I can also like share it if you want. I just opened it. I can share it.
Okay.
Yeah.
Yes. Our preliminary results for the cost of capital begin first with the peer group analysis, and then we go into our beta calculations, and as a last step, we have our assumptions. Regarding our peer group analysis, our main factors were actually the interested four, which are the interested classification, the organizational scope, the financial metrics, and the comparable business and operations. And the idea of this slide was to present some financial ratios for our peer group, which were four companies: Microsoft, SAP, SAP, and Oracle. And actually, we present there the average of these metrics. In the second slide, which we have the beta calculation, and in our results were that we have a levered beta for SAP of 1.1311 and an unlevered beta of 1.0428. Also, we adjusted the beta, and we found that we calculated that it was 0.97. Below, we present some a scatter plot and the graph. And in the scatter plot, we can see that most data points lie within or are close to the line. So we have high correlation. And in the last slide, which is our assumptions, we have calculated the cost of equity, and the implied cost of equity in our calculations is 7.63%. Here, the cost of debt, regarding the cost of debt, we estimated an implied cost of debt of 4.37%. And our weighted average cost of capital calculation was actually between the range of 6.75% to 7.75%, and we took the midpoint, which is 7.25%. And on the last, in the last table, we have estimated the average effective interest rate, which was 20.15%. And our remarks were that we had a strong growth in the IT. We noted a strong growth in the IT market, especially for cloud services, and also that the high inflation leads to high interest rates, in the long run, which increases the debt financing costs, and additionally, that economic growth stays stable. That's it.
Okay. Thank you. Do you have any questions?
Me?
Yeah.
Yes, I have a question regarding the peer group.
Mm-hmm.
And actually, how we can, I mean, I took some financial ratios, although I think it should be more better related, right? More as I saw from the Excel spreadsheets, I think it for the peer group analysis, we had there was the bid spread column also, and some liquidity metrics, and also some other
you mean the statistical significance criteria?
Exactly.
Yeah.
The R squared, and yes.
Yeah. Yeah. For the peer group analysis, for like the peer group creation, or if you want to come up with a peer group, then I think it's totally fine what you show here, because this is like some basic information on the peer group companies, like market cap, some profitability metrics, and E ratios, and so on. I think that's a very good description.
Okay.
But you're totally right. If you then go to the beta calculations, then here, yeah, I mean, you show it here, like the R squared of your company. You could also show R squared of your peers, the t-test for your peers. Yeah, you could also show the volume traded or the value traded for your peers.
Mm-hmm.
But that's very detailed then. So you don't need to do that. But yeah, of course, if you want to draw focus on the statistical factors, then of course you can show that. Yeah. So it's really up to you. It's not necessary, but you can do that, right?
Mm-hmm. Okay.
I would have a question regarding the beta factor. So you took the company beta factor in the end, right? Or did you take the average, peer group average?
In which
Okay,
part?
so you have 3 cases basically, and there you take yeah, 0.94. That's then okay. So you take the company beta factor, right?
Mm-hmm.
And how did you measure that? What index did you choose?
For
SAP, for example. Against which index did you do the regression of SAP? Or how did you calculate the beta factor?
I
Or is it from the annual report, or?
I need to check that.
Okay. Yeah, please check that, because I would suggest that you calculate it on your own, the beta factor, and not take it from, for example, annual reports. And there it's very important against which index you calculate the beta factor. We always recommend to use the local index. For SAP, it would be the German index, for example. For Oracle, Microsoft, I would assume, I don't know, S&P 500, something like that. And yeah. Okay, and another thing here, yeah, you have here different cost of debt, right? You have here effective interest rate of 2%, and then here you have pre-tax cost of debt of 5 to 6%. And what's this here? This is how did you calculate this one? 5.5%, for example. You can also check it later, but yeah, always be prepared that we ask like everything you show us here. We're gonna ask about that and how did you come up with that, and yeah, just please be prepared to answer. Yeah, basically what you show on the slides. And also what's interesting here on the next page. I'm sorry. That's is this the last slide? Yeah.
Yes.
Yeah. You have here a risk rate of 3% and a market risk premium of 4%. How did you come up with that? Because it's quite low. For example, in Austria or in Germany, we have risk-free rates of, I don't know, 1% currently. And market returns of, I don't know, 8% and market risk premiums of 7 to 8%, something like that. So 4% market risk premium is very low, and 3% risk-free rate is very high. So yeah.
Okay, I will take it as well.
Okay. And you also included an additional risk adjustment. Yeah. Would be also good to know what's that. Because, for example, we typically do not use additional risk adjustments. Yeah, but if you can explain it, then yeah, of course we can discuss it.
Okay.
Okay. Okay, then let's go to the second group. Okay.
Yeah, group B.
Yeah, group B.
Okay, I can share my screen. Can you see the screen?
Yes.
Okay. Okay, so for the cost of equity, I think I won't talk too much about the calculations, but more on the assumptions. So the base rate I took from the link that you provided on the 30-year German bond.
Mhm.
And then the equity risk premium, that's maybe also a question that I have that we can discuss later. So I wasn't sure. We looked at the performance of the DAX for the last 5 years minus the base rate, and then we have the equity risk premium of 2%, which is quite low. And I saw on the KSV that you should assume something between 7 or 9% normally. So I wasn't sure, should we take the one we calculated, or should we just assume it to be 7%?
Mhm.
So
Do you want to discuss it now or after the presentation?
is it okay? Maybe we do it afterwards. I'll go through the other things.
Okay.
So yeah, but so for now, I just took the based on the performance of the DAX for the last 5 years, which was quite low. That's why also our WACC at the end was quite low. And the beta factor was also measured against the DAX for the last 5 years. And yeah, that's how we came up with the cost of equity. And for the cost of debt?
Yes, so for the cost of debt, we assume the same base rate. The credit spread and the country risk premium is taken from NYU Stern. They have a full, so I did not calculate them separately. The reason why it is 0% is essentially because the debt is listed as a AAA, which is I believe among the rare ones in Europe with a AAA rating. So that's briefly about the assumptions for the cost of debt. And then, yes, for calculating the weighted average cost of capital, we took the average debt to equity ratio of SAP. And then we just use our previous assumptions for the cost of equity and to get the WACC. And then for the peer group, we just analyzed the levered beta and the WACC. The ones that we got for SAP are obviously, well, the levered beta is higher than the industry average. And for the WACC, due to the reasons we wanted to discuss, we actually got a much lower weighted average cost of capital in comparison to the peer group.
Mm-hmm. Okay, thank you. Then let's go through your questions, right? First one was regarding the equity risk premium, right?
Yes.
Yeah. Yeah, it's a very good observation. If you try to calculate it, then it really depends on the time frame you analyze. You have, for example, I think in the last year you had very high returns. Basically, post-COVID, the post-COVID recovery. If you invested at the beginning of the COVID pandemic, and then you had a 1-year return of, I don't know, sometimes 50%. You just invest in the S&P 500. I think sometimes even 80% 1-year return. If you had invested, let's say, right before the beginning of the COVID pandemic, then you might have had a loss due to the high fluctuations, the high decrease during the pandemic, and so on. So it really depends on the time frame. And you took here the last 5 years, right?
Yes.
Average 5-year return. Yeah. So it really depends, and there are some analyses. I think for Germany was by Steele. I think he's called Steele. He analyzed equity risk or equity returns, equity risk premiums over the past 60 years or something, and he concluded that typically they should be like 5% or something, 5 to 6% market risk premium. The recommendations, the EDW recommendation for Germany says something like 6 to 8% based on their own analysis over the past, I don't know, 50 years, 60 years, something like that. Because if you have a very long time frame, then all of these short-term fluctuations with sometimes plus 20% in 1 year, minus 20% in the next year, plus 50% in the following year, and so on. All of these fluctuations, they cancel each other out, and you should really have a sustainable level of the market risk premium or market return. And that's basically what this recommendation by the EDW, which is from 6 to 8%, or the KSW in Austria, which is from 7.5 to 9% market return, is based on. It's based on very long-term analysis and also forward-looking analysis, taking implied market returns into account. That's basically, it's all based on very long-term analysis and taking all of the different crises and so on into account. And so I think it's better to use that instead of calculating historic returns on your own, because you will always have the difficulty. If you use this year, then the return is quite high. If you use the next year, it's quite low, and so on. So really determining the right time frame is very difficult, because you would also have to account for business cycle, for economic growth, slowdowns, recessions, and so on. So we would recommend really to use the range, the proposed range, but within this range you could do your own analysis. For example, we calculate implied returns based on the current market cap, analyst forecasts for earnings, dividends, and then we basically calculate how much market return is necessary so that the current market cap equals the present value of future dividends, expected future dividends. So and then you should also come up with more reasonable numbers than the 2% you have here, for example.
Okay, thank you.
Okay, and just one remark for a credit spread. It's quite interesting. That SAP has a AAA rating. Nevertheless, what Damodaran shows for credit spreads, I think it's mostly based on country bonds, so on, for example, German government bonds, which are also AAA rated. But you could argue that because SAP is a company and has not like the backing of the German government behind it, or is not as risk-free as Germany as a state, that there still is a small credit spread, but totally fine that you have zero credit spread in this case. Okay, and could you also go to the next page, please? Yeah. How did you come up with the peer group WACs?
Hi. It is. Can you hear me?
Yeah.
Yeah, so it's from I think Yahoo Finance, or I found it on Capital IQ. So yeah, it was already calculated there.
No, but I think it's a very good comparison to show that here. That's also a recommendation for all groups, that you could just look up the analyst WACs, for example, in analyst reports. The analysts typically also calculate WACs for example, for peer group companies, for SAP, maybe in the annual reports, you will also find some information on that. And then just compare what you calculated with, for example, analyst WACs, just to see if you're like in a range, if it seems reasonable, or if your WAC is too low. For example, in this case, your WAC is 5% lower than the peer group average, and yeah, but yeah, we discussed it with the equity risk premium, but it's always just a good comparison. Yeah, in valuation, most of the times you just do benchmarking and compare different KPIs, different metrics, and so on. And you could also do it for the WAC, for example. Just compare the calculated WAC, your calculated WAC with, for example, peer group WACs, analysts, WACs calculated by analysts, WACs shown in the annual reports, and so on. It's always good to have more benchmarking. Okay, do you have any more questions?
No.
Okay, then let's go to the last group.
Yes, I will share my screen. Or can you maybe open the presentation? Otherwise, I have to restart Google because I.
Yeah, I can share it. 1 second. Yeah, foresee.
Great, thanks. All right.
Okay.
Yeah. So what we did for the calculating cost of capital, we firstly calculated the betas of our company and of our peer group. As peer group, we have the same as the first group, I think, Oracle, Microsoft, Sage. Yeah, we calculated the betas by Oracle and Microsoft using the index from NASDAQ and Sage from FTSE 100, because Sage is based in the UK. And yeah, we come up with the levered and unlevered betas. Then we looked on Damodaran for the industry beta, levered and unlevered. Then on the left side, we make a quick overview for the industry beta, levered, unlevered. For the beta peer group, the average for our company, and yeah, the average overall.
Just one question. The beta factor on the right hand side, it's always the unlevered.
Yeah, it's always the unlevered. Okay. Yeah, on the next slide, there's the calculation for how we come up with our beta. So we use the DAX as the index. We looked at the time frame 5 years from January 2017 till December 2021. Yeah, we took the German corporate tax rate of 30% and a debt to equity ratio of 33%. And then we came up on a levered and unlevered beta. And I think Anna Maria will continue now.
Okay, on the right side, we can see the synthetic rating. In the documentation, we find out that SAP has a rating of A2 in the past 3 years. And this was our assumption for the next calculations. I'm going to explain. We also calculated a synthetic rating, and we got a BBB rating for SAP. And here I'm going to have a question at the end of the presentation. Okay. For the credit spread, we use the provided website from Damodaran. Also for the base rate, for the tax rate, as my colleague said, we use the one from Germany, which is 30%. And we have after tax a cost of debt of 0.88%. And on the next slide, I will have a better scheme. Okay, so we can see that we calculated our WACC based on our cost of equity and cost of debt. As my colleague explained, our unlevered beta is 0.81 and our risk-free rate is 0.12. This one is like the base rate is taken from the website, from the Deutsche Bundesbank. And in the end, our cost of equity is 8.30%. Next, for the cost of debt, we use the Germany tax rate, which is 30%, and the credit spread is 1.14. And this one is also taken from the table. And for this one, we selected the A2 rating. In the end, our cost of debt is smaller, of course, than the cost of equity and is 0.88, which for our company, I think it's good. Even though the cost of debt would be less costly than using equity to raise the capital. For that, we need to repay it. So SAP would have to repay it in the end. So 0.88% is good. They don't have to repay a huge amount of money. But equity is better because it will generate a higher rate of return than the debt. And in the end, our WACC is 5.21%. And this represents that SAP needs 5 cents to source an additional €1 out of the investment. So that was our approach for calculating WACC and cost of capital and debt.
Thank you very much.
Mm-hmm.
You had a question, right?
Yeah, regarding the rating on the previous slide. So we followed the steps you provided us in the PDF from the last guest lecture, and we got the synthetic rating of BBB, which is slightly worse than the one we found in the reports on the internet. And for the assumption, I was okay, it's better to take the A2 rating because, okay, that was validated in the reports by analysts. And, okay, we showed that we also calculated it, but do you think it would be better to use ours or the one in the reports? Because I thought that maybe, okay, maybe we did a mistake, or I'm not sure. I don't think so, to be honest. But like it's a slight difference between A2 and BBB, and this changed the result.
Yeah, it's totally common that you have differences here, because rating agencies, or what we do, we only consider financial ratios for the synthetic rating, and rating agencies also consider more qualitative factors. And for example, they could conclude SAP operates or that SAP is operating in Germany, maybe is an improving qualitative factor, or also that SAP maybe they also have like a rating on the business model of SAP and so on. But yeah, what we do is according to Gleisner Füßer, they say, I think in 90% of your valuations, you would come up with the same rating as the rating agencies, or 70%. But in some cases, you also have like more or qualitative factors, then improving more mostly your rating. So yeah, it's totally fun. Interesting thing is that the first group had a AAA rating, right? The second group had a AAA rating. Where is this rating from, or a AAA rating from?
Okay, I took the rating from Moody's.com website for SAP. So I found there some articles for 2019, 2020, and 2021.
Okay.
Oh, ours is from Moody's website.
And the second group? Do you know where the AAA is from?
So the AAA that I mentioned actually refers to the German government bonds. So those are the credit spread is based on the German government bonds.
Okay. Yeah, you should base the credit spread on the company rating.
Okay.
I would have one more question, if I.
Sure.
On the same slide where we wrote down the debt to equity ratio, when we checked the Damodaran website for the industry, we found like a very low one, which is 5.68 compared to our peer group and our company. And that was quite strange. Just a second, maybe I can, or I don't know if I have the website, because where is it? One moment, please. Data. Okay. Yeah, I think it's also in our presentation in the first slide. On Damodaran website, we took the industry called software system and application. Applications. I mean, this was the only one in the whole list that could be used for SAP. But like, yeah, the debt to equity ratio, I found it quite low compared to what we calculated and we found for our firms. Maybe these firms, because those are more oriented on cloud services, and maybe that's the reason of this discrepancy, or
yeah. Keep in mind that Damodaran basically uses all like all companies in this industry. So he uses all of the companies, and you have SAP is a very mature company. I would guess it's a leading company in this industry, and so for them, I would assume it's easier to raise debt financing.
Okay.
For them, it's easier to go to banks and ask for loans or to issue bonds, for example, because they are an industry leader in some way. And many other companies maybe have more difficulty with that. For example, also if they are more startup-like, then they typically have lower debt levels, because with that you always have to pay interest each year. And if you have negative operating results, you cannot pay interest. It's just not possible. So if you're in the startup phase, then you can't really have a lot of debt financing, and could be also for example, for not that mature companies with fluctuating operating profits. Then it's also more costly to have that financing. So could be an explanation, but I'm not an industry expert, so
okay.
Yeah, but could be an explanation.
They could also use like tax shields, so they can deduct some, like the interest expenses, or
Sure. Of course, that has some positive effects, but if you have negative operating profits, you cannot use tax shield. And so tax shield is a positive effect, but financial distress is then a negative effect. And if the costs of financial distress are higher, then it's better to reduce your debt levels, for example. Modigliani Miller, for example, in their papers, they analyzed like the perfect capital structure, and it's always like a trade-off between a tax shield and more or less the cost of financial distress. So you navigate between those two, and sometimes it means you cannot afford to have high debt levels.
Yeah, true. Thank you so much.
Thank you.
Can I ask one small question as well?
Sure.
So we calculated the levered beta for Oracle, and then we wanted to calculate the unlevered beta. So we needed the debt to equity ratio, and we found on the internet that Oracle has negative
7 something, I think.
Yeah, has negative equity, and the debt to equity ratio is therefore minus 7.6 or something.
Yes, exactly.
So
but negative debt or negative equity?
Negative equity.
That should not be possible.
Okay, then maybe the statistic was wrong.
Because basically the equity, you use the market value of equity, the market value of debt for the D ratio. So we always use market values, and in this case it would be the market capitalization of Oracle, and it has to be positive.
Okay.
The lowest possible market cap is, I don't know, €1.
Okay.
So it has to be positive. If you look at book values, for example, you could have negative equity in the book value in the balance sheet. It's not good. It's really not good, but it could be, yeah.
And one other thing?
But net debt could be negative, meaning that you have more cash than debt, for example. We often look at net debt instead of total debt, and then you could have negative net debt, and then you would have a negative DE ratio, I think. Yeah.
Okay. And another thing, each group now had a different tax rate. I think the first one had 24, the second 22, and we had 30. So which one do you take there? Like an average from all the countries the company operates in, or what's there the solution?
To be precise, you would need really tax planning for your company. I assume we all don't have the information to do that correctly, because you would really need to have, for example, the EBIT in each country or in each entity in each country if there are no tax groups. For example, if you have tax groups, let's say all German companies are together in one tax group, then you would need the EBIT per country. Then you would need to know the financing per country, and so on, and really calculate your taxes for each country individually. And then you can calculate also like a weighted tax rate based on that.
Okay.
But could be difficult. It's the same for the country risk premium. You don't have to do that for the case study, but you could use a country risk premium based on, for example, revenues per country. If you have, I don't know, 70% of your revenues in Germany, they don't have a country risk, for example. They have zero country risk. But if you then have 10% of your revenues in, I don't know, in Italy, for example, Italy has a country risk premium according to the Modern. So yeah, you could look into that, but it's not necessary for the case study. Also for the tax rate, it's totally fine to just use the statutory tax rate, which is 30% in Germany. Totally fine. But you could also use, I don't know, the average tax rate paid in the last years, or what SAP reports in the annual reports. Yeah. Okay. do we have any more questions? Yeah, then I think we have a short break now, and then we see each other in the guest lecture in 10 minutes. Okay.
Thank you.
Thank
Bye.
you.
you.
Bye.
Thank you.